evening. I'm going to talk about property, which won't surprise you. And as the name suggests, Custodian Property Income REIT is all about income. And I think there's not enough focus given to income sometimes when people look at real estate. And I'll tell you why I think it's important as we go through and tell you why we think we deserve the mission statement that we have, that we should be the REIT of choice. First thing to say is we are a diversified fund, a very proudly diversified. It has been the trend through recent years to become increasingly specialised, and we don't think that suits all investors. We've got 160 properties spread across the UK, over 300 tenancies, and that is about 615, give or take, £1 million worth of real estate assets. Our absolute focus, as I said before, is income. And paying our dividends out of income, fully covered by earnings, has always been central to our strategy. So for the year to March, earnings of 5.8p, covering a dividend of 5.5 pence per share, with fairly low gearing. Target gearing of 25%, it's currently 29%. Given where the market is at the moment, given what's happening in interest rates, we think that is close enough to target that no one should panic. The portfolio is split by value, nearly half the portfolio in the industrial and logistics sector. That's been very busy over the last few years. But we also have a substantial proportion of capital invested in retail warehousing, some in offices. Ooh, you might say. We can talk about offices. I wouldn't be surprised if one of you had a question for me about offices, so I'll leave it for that later. And a little bit on the high street and the rather unhelpfully entitled other, which is everything that doesn't fall into the other categories that you might expect to be considered commercial property. So things like drive-through restaurants, children's day nurseries, other bits and pieces. Now, I said we are very keen on income. And just for reference, all the properties you see in these images are properties in our portfolio, to give you an idea of the sort of assets that we own. I'm going to talk about worth and value. There is an awful lot of analysis done by those that monitor the property market on net asset value. But, in the words of Tina Turner, what's NAV got to do with it? Because who wants to be equity rich and cash poor? There's too much focus, in my view, on the net asset value of a real estate investment trust. And let's face it, as a shareholder, you can't access net asset value performance because your unit of worth is the share price. Much more important is earnings. And what this chart looks at is the net asset value, the blue line, of Custodian Property Income REIT over the 2 years to March 23. And you can see that the market got terribly excited in 2022. Values rose very quickly and then collapsed very sharply in the final quarter of last year. Very happily, our shareholders, probably because I've been banging on about it for 10 years, didn't chase the value of the share price up as values rose. And you can see the grey line is our share price movement over those 2 years. And you can see how it has oscillated around our earnings per share, the red line. So I think that Custodian Property Income REIT shareholders have understood that the real worth of investing in real estate is on that recurring income that comes from earnings and not by chasing valuations. Let's face it, valuation is what other people think the properties would sell for in the market, not necessarily what we think, and hopefully our shareholders think they're worth. Income and income growth is what you should be looking for. And right now, despite all the bad news you hear in the investment market, on the ground, occupationally, the property market is in pretty good order. We're seeing strong rental growth, high levels of occupancy, our vacancy rate is falling, and what this chart looks at is the net initial yield of the portfolio, split out sector by sector, and the equivalent yield which takes into account the prospect of rental growth that our valuers, independent valuers, believe each of the properties has. And you can see from a net initial yield of 5.8%, equivalent yield of 7.3% suggests that there is rental growth to come. And the greater the gap between those two numbers, the more rental growth. So you can see, particularly in the industrial and logistics sector, strong income growth potential. And just by way of an aside, let's really get into the weeds of real estate. In most regional property markets, industrial rents are £5.50, £6.50 a square foot for standing buildings. If you were to build a new building, sort of sub 100,000 square foot, which is sort of the market we're in, so not the great big logistics assets that you see on the side of the motorway, but work-a-day industrial and logistics buildings. If you were to build new, in most regional markets, rents would be over £10 a square foot, against passing rents of £5.50 to £6.50 a square foot. So new, should you build it, you're almost doubling your rent. Good refurbished properties, you're probably £7.50 to £8.50 a square foot. So a huge amount of latent rental growth that's sitting in those assets that will come out over time. And rental growth is what you should look for. You know, people often ask, is property a good hedge against inflation? And the answer is yes, it is, when rents are growing. And here's an interesting thing I read. Just when everyone is saying, get out of property, property's had a good run or had a bad run last year, in the last 12 months, because of inflation, the real value of those assets has made them even better value, because valuations have fallen, and in real terms, everything else has gone up. So they look even better value today. So even though the values have fallen, and in real terms fallen even further, the rental growth is moving the opposite direction. When you're investing in real estate, it's really important to look at the strength of the balance sheet of the investment company. I'm happy to say Custodian Property Income REIT has always taken a very conservative approach to debt. Even when, through the last 10 years, it perhaps would have been cheaper, in fact, it definitely would have been cheaper year on year to have floating rate debt. We opted for long-term fixed rate debt, and you can see in this chart there are 4 tranches of debt. The first on the left is our revolving credit facility, and the other 3 fixed rate debt at 3.9%, 3% and 3.4%, which across all of our drawn debt, 178 million drawn, as I said, about 28% loan to value, there's a weighted average cost of debt of 4%. But that's sitting against a portfolio that's yielding 5.8 with reversion to 7.3. So the debt is accretive. One of the interesting things about investing in real estate over the last 10 years is that we've slightly swum against the tide. Most investors have opted to buy prime real estate, which you could fund with debt because debt was so cheap. It's not so cheap anymore. And that prime real estate strategy doesn't hold up in the current interest rate environment. It always used to be the case, and I'm sure it will become the case again, that prime assets are bought by institutions who are buying with equity, with no debt, and the rest of us buy secondary property that's higher yielding, that can support the cost of debt. Now, happily, we never went down the prime property route. Now, you might think that's an odd thing to say, because surely I'd be saying our properties are all great. Secondary property is not a dirty word, and you'll see by some of the pictures you've seen and more I'm about to talk about, that secondary property let to good tenants can produce a higher marginal return that will, in the future, cover the rising cost of debt that we're almost certainly going to experience. So what does all this mean in terms of performance? 2022 was an interesting year. We went into 2022 and it was pretty clear to anyone who'd worked in real estate for more than 5 minutes that prices were too high, and they kept getting higher. And you saw that blue line in the earlier chart. And what that meant was that through the 12 months of 2022, the aggregate share price total return from UK listed real estate was negative 34%. And had you invested in some of the red-hot, most attractive prime logistics opportunities out there, that could have been negative 45%. Custodian REIT, negative 2%. So very meaningfully different experience. And it's because we've had this widely diversified fund. I've got a frog in my throat. This is going to play havoc. Excuse me. I don't think I fixed it, but we'll carry on. So negative 2%. And as we come into this year, valuation has been relatively stable. We saw a huge correction in Q4 of last year. But through this year, through the 6 months to June, and these are still June figures, September figures come out very soon. You're a gentleman, thank you very much. Valuation's been pretty stable, only down, and they're still down 1.2%. Our dividends have been very stable, at 5.5 pence per share, and the share price, again, pretty stable over the course of the year, only down 3.5%. So still, in these volatile markets, when most people are switching away from property, we're still seeing a positive share price total return because of the defensive nature of the income component of our total return. Okay, I've coughed a bit, I've made a bit of noise. You might not have remembered anything I've said. This next bit is the bit to remember. This is why we do what we do. What this chart is showing is the net initial yield of properties traded in the market. It's whole market data going back to 2000. The dark blue line is properties traded with a value of less than 10 million, and the light blue line, properties of greater than 10 million. Now, we're a small lot size investor. So it gets diversification, 160 properties. Average lot size is about £4 million. And what are these lines showing you? They're showing that there was a pretty consistent margin of about 75 basis points for buying small lots versus large for the first 10 years of the century. Let's call that the risk premium. But let's face it, it's not all risk premium. There's a huge amount of hassle factor in there. People would much prefer to own a small portfolio of large properties rather than a large portfolio of small properties. Easier to manage. And so there's a little bit of hassle factor in there, but let's call it the risk premium. What happened in 2010 to see this huge divergence? Did we see a change in the risk profile of small properties versus large? No, we saw a change in the supply and demand dynamics. Back into the market in 2010 came the property unit trusts. They're on their way out now, but they were back into the market very meaningfully then. We saw an upweighting to real estate from UK pension funds, and we saw overseas money in the form of both private equity and sovereign wealth funds all coming into the market, all chasing relatively large, relatively prime assets, restricted supply. Values went up, yields came down, and at the same time, they were selling down, those same people were selling down their smaller properties because they weren't getting enough bang from their buck from managing them. So what we're seeing is supply and demand dynamics shifting to open up a 150 basis point margin. Yet the risk premium, and let's face it, it's not all risk, the risk premium is 75 basis points. But if you're getting a 150 basis point margin with only 75 basis points of risk premium, you're getting 75 for taking no additional risk. That's why we pursue a smaller lot strategy, because it generates higher marginal income, and over medium to the long term, income is going to make up 75 to 80% of total return from real estate. So it makes complete sense to us to focus on those assets that have a higher return without taking additional risk. Of course, you could always buy higher yielding property, but you'd typically take on more risk. But we think that this is a little opportunity to weave gold out of straw. And we're very broadly diversified. The nature of a smaller lot strategy, you end up with an awful lot of properties. And what this is showing is the amount of income paid by any one tenant in the portfolio. So you can see we're not really over-reliant on any single tenant. And even amongst our largest tenants, I know you're going to call me out on this, but they do call themselves Menzies Distribution, not Mingies. And Wicks, we've got 8 properties let to Menzies. We've got 3 let to Wicks. So there is further diversification within those slices of the pie. What it means is we have no one property let to a single tenant that represents more than 1.5% of the rent roll. So genuine diversification. And it also means, and what it doesn't mean by having a small lot strategy is that we've got a portfolio full of corner shops and workshops under the arches. You know, these are good quality tenants, and you're going to recognize many of those names. And if you looked in our annual report and saw all of our tenants, you're going to see that they're largely household names. And this is a look at the quality of our tenants by reference to Experian credit rating. And what it shows you is that 89%, so nearly 90% of our tenants are considered by Experian lower than average risk. Now, you'll also note, eagle-eyed amongst you, those who are focused on risk, that some of our tenants are classed as imminently failing, which is, I think, unfortunate for them, but actually it's often just the opportunity we're looking for in our properties. When the tenant fails, unlike an equity investment, whereas if the business fails, you lose everything, we get the property back. And when we get the property back, it gives us an opportunity to make the investment that probably the tenant has been making, because they've been imminently failing, and improve the rent roll, improve the quality of the building, and it's not always bad news, and sometimes it's just what we need to happen. So a diversified portfolio of smaller regional properties does not mean you have to give up on the quality of the asset, you don't have to give up on the quality of the tenant, and importantly, you don't give up on the quality of the income. And with that huge spread of tenants, you end up with very forecastable, predictable income. And the compound effect of that recurring income creates that very defensive total return that we've talked about. This is the interior of an office that we have just refurbished in Manchester. So this is what the future of offices looks like. And I've included it as an image as asset management because this is what we do. It's a 365-day-a-year performance managing a portfolio of assets, and you have to keep them up to scratch. It's just like with your own houses. And we have all experienced in our lives our grandparents dying and their house needing to be sold, and it's still got a 1960s kitchen in it with probably a 1950s tumble dryer, and it's brown and it's grey, and it doesn't get full market value because it hasn't been looked after. And it's our job with commercial property to make sure our properties are not brown and grey with a 1950s tumble dryer in, but they are modern and they meet the requirements of tenants in the market. So that constant investment in our buildings is what protects the long-term cash flow. Energy performance certificates are how we rather crudely measure the environmental impact of the properties in the portfolio. And in England, not so in Scotland, but in England, there is regulation called Minimum Energy Efficiency Standards, MEES regulations, that require all properties to be C-rated or above if you are going to be able to let them by 2028 and B-rated above by 2030. So there's real legislative pressure. And I've included it here because if you'd asked me about the environmental impact of our portfolio 5 years ago, I would have told you, yes, we've got an environmental policy, and I could probably tell you which drawer in the office it was in. And maybe 4 years ago, I've said, yeah, look, we've got it out of the drawer, and it's an important document, and it's something we refer to regularly. It's now just how you manage real estate. If you're not thinking at every possible turn, how can we improve the environmental performance of these properties? Where can we add solar PV? Where can we move to LED lighting, putting in air source heat pumps? Then those properties are slipping and they're not going to be in demand by tenants. And one of the things that's really changed in the last few years is that tenants have fallen into line behind us. They want to see those high quality and low environmental impact buildings. Now here's an imminently failing tenant, Pizza Hut. They failed, put the business into company voluntary arrangement. The time has just gone to 0 minutes. This is going to make up part of the question, so don't worry about it, it's fine. And as a result of them failing, we took back possession of the property We refitted it. We've improved the environmental performance certificate from a D to an A. We've increased the rent by 35% for only a £200,000 capital expenditure and doubled the value of the building. So that is, in fact, the same building. We added a drive-through lane and reclad it. And another example before we move to questions, here is an industrial building in Winsford in Cheshire. It was let to H&M. They were paying us £423,000 a year. We spent 1.9 million on it at the end of the lease, and that gave us a net increase in value after the cost of that capital expenditure of 2.2 million, and getting on for a doubling of the rent from 423 to 740,000, and we've improved the environmental performance certificate from a C to an A. So real moves forward. Let's move to questions. I'll leave my thoughts on the market on the screen. Any questions?
Thank you very much, Richard. Yeah, so if we turn to questions from the floor, question there, go to that first.
So, offices, with people working only one or 2 days a week, is there not going to be a downsizing of the requirements for offices? And also, you talked about the length of your debts. You said it was long, but what is the average length of your fixed rate debt?
Yeah. Second question first, 6 years, just under 6 years now, is the weighted average term of our fixed rate debt. We're all here tonight. This isn't a webinar. People like to get together. People want to go back to the office. There is a lot of fear in the office sector. There's also a huge amount of nonsense spoken. People are talking now about stranded assets. We've got these stranded assets. Nobody wants to rent them. What they're talking about is obsolescence. And obsolescence has been a very key part of office investment since time began. All the offices we all worked in 30 years ago would look completely out of date today. And offices have changed through our working lives. And what we've seen over the last 3 years is we had 3 years when everything was frozen in time. And so we got a bit of catch up, but we were on a continuum anyway. Life was changing and people were working from home a bit. We'd gone from people having their own offices to being open plan to desks getting smaller and smaller and smaller. And now people want a bit more space. They want space to have video conferencing calls. And to be perfectly honest, whether you're in the office 3 days a week or 5 days a week, when you're in, you want everyone in. So you need that office space. I mean, the Victorians would be appalled that we're only working 5 days a week. So the fact that people are in the office 3 days a week, I don't think we should worry about. But the sort of offices people want. No longer as a landlord can we clear out a floor at the end of a lease, put in a grey carpet, paint the walls white and say, help yourself. And by the way, you've got to fit it out. And at the end of the lease, we want it back with grey carpets and white walls. So we're producing the offices you saw on the picture there, fully fitted. That building has 5 floors, 3,500 square foot of floor. And on the top floor of the building, it's in central Manchester, we've created a business lounge, extra meeting rooms, a roof terrace, a coffee bar, all for the benefit of the tenants of that building. So high amenity offices. But guess what? People are prepared to pay for it. The rents in that building were £20 a square foot. Our expected rents, and we launch it next week, so fingers crossed, over £35 a square foot. People are prepared to pay for that high level of amenity. And it's not wildly dissimilar to the way we all treat mobile phone ownership, car ownership, student accommodation. All of those things, people want much higher standard than ever they used to have. Newer cars, £1,000 telephone in your pocket as a student is madness. But people pay for it, as they go along. People are prepared to pay for that high level of service. And that's what we're going to see in offices. So the office market is changing. But so what? It's always been changing. You've just got to keep pace with that change.
Excellent. Any more questions from the floor? We've got one here, gentleman in the green jacket.
Hello.
Oh, sorry, I missed that. Thanks, Chris.
Hello, Jane Morton. As a property income rate, how do you set your dividends?
We try and have a predictable dividend. Importantly, we want it to come out of earnings. So we want it to be fully covered by the earnings of the company every year. We are able to pay it out of capital, but we don't think that's right. A lot of our peers do pay part of their dividends out of capital. So we will forecast where we think our earnings are going to be, and we think it's important to get the rent that we collect as income into the hands of shareholders. Now, REIT legislation forces that on REITs anyway, because you are required to distribute 90% of your rental profits. We distribute much more than that. We try and get us the maximum amount of income into shareholders' hands that we can. And we set it by looking at the forecast, and we've got contractual leases running on average for nearly 5 years. So we've got a pretty good idea of what our income is going to be, not a bad idea of what our expenses are going to be. So we can look at those earnings and try and get as close to 100% cover as we can. We don't want to be 120% covered, because that means we're sitting on money that should be in the hands of shareholders. Does that answer the question?
It kind of does. I think the other...
Sorry, could you think about it?
Sorry. Looking at your slide, there seemed to be a premium on the retail side of the business from what I determined, given that's what 11% of your portfolio. I suppose it's this thing about how you diversify on the premium aspects of a changing market in a, dare I say it, not a premium site, a smaller site rather than a premium prestigious site.
Yes, I mean, often it's the premium prestigious sites that have been overvalued in the past. People have paid too much for them. And it's actually about looking under different rocks and stones to find those opportunities where the risk-return reward, we think, is more in favour of shareholders. So looking for that higher income return without just buying a very high-risk asset. And that's sort of what we try and do. But yeah, it's not reverse-engineered, the dividend. We don't say we're paying 5%. Now, how do we go about it? We buy the properties that we think will work best in the long term for rental growth, and then out of that drops the earnings, and from that come the dividends.
Excellent. So we'll come to you in a second.
Hello. Thanks for the presentation. Just page 5, which is the one I wanted to talk about. In industrial, which is quite a large part of your portfolio, has had a meteoric rise in recent years. Offices you've touched on, e-commerce and warehouse. I'm just wondering, are you throwing sort of things in the air a bit, and what's the direction of the company, or the opportunities which you're looking now that things have stabilised, because which is good, things have stabilised, because your industry's actually come to some sensible NAV conclusions last year, so you can build on it. How dynamic are you going to be?
Well, I hope we're not just throwing things in the air, and if I have, I should have tried harder at this presentation. We are very focused on those properties that we think will be the properties that we want to own this time next year. So just to put that into context, once a quarter, we have an independent valuation. Following that independent valuation, we will sit down as a team and we will go through every property in the portfolio, accepting there is no family silver. Every property has to earn its place in the fund, and we will ask ourselves, at this valuation, would we buy the property? And if we wouldn't, should we sell it? The answer might be yes, we probably should sell it, but actually we can't sell it until we have renewed the lease, and the lease doesn't run out for another 2 years. So we will work on that, do the asset management that's necessary. And so we are constantly refreshing the portfolio, trading out of the assets that we think won't work. Now, look, everything we buy, we think it's going to work, but you can't get them all right. And things change that you don't expect. A tenant that you thought would stay forever doesn't. They might outgrow the property. They might have been too successful. So we have to make decisions all the time about the properties that we own. So it is a very dynamic process. We will remain, I'm sure, weighted to industrial and logistics because that's where there is the most latent growth in rents. Actually, there's some real opportunity on the high street at the moment. If you're brave enough, and we bought a property on High Street, Winchester, last year. Initial return was 6.5%. Winchester as a city has been absolutely at the top of the tree for investors for the last 30 years. And investment yields have typically been 4.25%. So to get in after rents had fallen, so rebased rents, but with an initial return of 6.5%, we felt that was a value opportunity. And one of the benefits of being a diversified fund is you can take that opportunity. If we were so sector specific, we would just have to stay in the tracks that we had set ourselves.
Excellent. I think that's time's up, but if there's any more questions, feel free to speak to Richard afterwards. So thank you very much, Richard.
Many thanks.